If you have watched my channel before, then you know that I'm on a journey to amass $100,000 in annual dividend income. Now, I still have a long ways to go, and it is a journey, but the primary way I do this is by investing in stocks and ETFs that pay safe, reliable, and growing dividends. We talk on this channel a lot about a lot of individual dividend stocks that I like, and even some I don't like, but we also talk some about ETFs. One of my favorite ETFs is SCHD. However, in today's video, there's another ETF that's out there growing on me a lot, and we're going to talk about it today. I might even start liking it more than SCHD. So make sure you stay tuned throughout the entirety of today's video so you do not miss it. And with that being said, if you could do me a huge favor, click that like button down below, subscribe to the channel so you're notified anytime we drop new content or even have our live shows so you're notified. And with that being said, let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence and do not take this as financial advice. This day and age, it has never been more important to protect your data, your personalized data. Whether you're at a local restaurant, a Starbucks, the airport, a hotel, there's always cyber criminals that are lurking out there. As such, I would like to introduce to you today's video sponsor, which is Aura. Aura is a one-stop shop with many great features, all aiming to help protect you from these cyber criminals. It seems like not a month goes by without hearing about another data breach, so it's important for you to take this serious and protect your personalized data. Here are some of those features that Aura offers: identity protection, credit monitoring, antivirus software, VPN to offer safe browsing anywhere, and even parental controls, among other features. You often have to get these features through various different subscriptions. Not with Aura. One subscription does it all. The FBI's latest report shows that in 2022, there was more than $10 billion worth of losses just from cybercrimes. Get protected and give Aura a try. Right now, they're giving an exclusive deal for viewers of my channel where you can get 14 days free just to try out all the great features that they have. If you go to aura.com/Mark, you can get this exclusive deal for a limited time. Now back to our video looking at an ETF that's growing on me and may be passing SCHD in my portfolio soon. Let's first take a look at SCHD to remind you of the makeup of that ETF. SCHD has had a lackluster previous 12 months with the stock only up, or the ETF only up 1%, while the S&P 500 has climbed 12% over that same period. SCHD does have a low expense ratio of just 0.06%, making it a great low-cost option. Expense fees can really eat into total returns. Here's a look at the sector breakdown for the ETF. Industrials is the top sector with exposure of nearly 18%, followed by healthcare, financials, technology, and consumer defensive. For a while, technology was actually in fifth, but given the outperformance, it has climbed up recently and taken over that fourth spot within SCHD. Technology, though, only accounts for 12.6% of SCHD, which is part of the reason for the underperformance over the past 12 months, as technology has been a top-performing sector along with communication services, which only accounts for 4.4% within SCHD. However, the ETF is very well-rounded, as you can see. Here's a look at the top holdings for SCHD as of September 7th. Cisco is our top holding with a 4.5% exposure rate, followed by Broadcom, Amgen, the Home Depot, AbbVie, Chevron, Merck, Texas Instruments, the Coca-Cola Company, and PepsiCo rounding out the top 10. These top 10 holdings account for 41% of the ETF, and SCHD has a total of 104 total positions. In terms of the dividend, SCHD pays a dividend yield of 3.5%, and the dividend has grown at an average 5-year clip of 14%, which is quite amazing. Investors have seen the dividend grow for 11 consecutive years and counting. So very diversified in terms of holdings. And when you look at the dividend yield is actually higher than some of the high yield dividend ETFs like VYM or HDV. And then when you look at dividend growth, SCHD has faster dividend growth than some of the dividend growth ETFs, such as VIG and DGRW that we've looked at on this channel before. So it really checks off a lot of boxes, but the one issue with SCHD, at least in 2023, is their lack of technology exposure. A lot of these other ETFs have technology as the number one exposure or the number one sector, which is why their performance has been so much better in 2023. But you get a well-rounded, well-diversified portfolio with SCHD. All right, before we unveil the ETF, let me tell you about one more special promotion over at Webull. If you're looking for a new brokerage or just want some free stocks, you can sign up using my link down in the description below. They will give you up to 12 free stocks that could be valued up to over $30,000. Just open a new account and deposit any amount of money. Check out the link down in the description below. Okay, now let's unveil the ETF that we're here to talk about today. As you know, if you've followed me for any amount of time, you know that I love dividend growth as it puts the power of compounding into overdrive. And some of the dividend growth ETFs that we've covered on this channel have been DGRO as well as VIG, but neither of those are the ETF that we're talking about today. The ETF that we're talking about today, are you ready? Is the Wisdom Tree US Quality Dividend Growth ETF. Stock ticker DGRW. The fund has been around since 2013 and has increased in value by 234% since inception 10 years ago. Not a bad return during that time span. The ETF tracks the Wisdom Tree US Quality Dividend Growth Index, which tracks large cap dividend growth companies here in the US. The ETF is up 12% over the past 12 months, going toe-to-toe with the S&P 500. And when we look at the top sectors and top holdings, you'll see why. The ETF has assets under management, or AUM, of $9.67 billion, an expense ratio of 0.28%, so much higher than SCHD, and this is one negative that I draw from DGRW, but still not crazy high, but not low cost. Over 0.50 is really when you have to think twice about fees. Okay, now let's look at the top sectors. We looked at the top sectors for SCHD. Now here's the top sector exposure for DGRW. Number one on the list is technology, which speaks to the solid performance the ETF has seen over the past 12 months. The technology sector has a 30% exposure rate, more than double that of SCHD, which only had roughly 12% exposure. Consumer defensive is the next sector, followed by industrials, healthcare, and financials. Again, very diversified still, but overweight technology. I really like that, but also, given the outperformance from the technology sector, we might need to wait for a pullback in that sector to find an even better price to buy more DGRW. Now let's take a look at the top holdings, and with that overweight in technology, it should not come as any surprise to see Microsoft, Apple, and Broadcom as the top three holdings. They are followed by Johnson & Johnson, Procter & Gamble, the Home Depot, Cisco Systems, Merck, the Coca-Cola Company, and Walmart. The top 10 holdings account for 36% of DGRW, and in totality, they have 297 positions. Looking at the dividend, DGRW has a much smaller yield, which makes sense given that Apple and Microsoft are the top holdings and have yields less than 1% themselves. DGRW has a dividend yield of nearly 2% with a 5-year dividend growth rate of 9%. I would like to see that get over 10% in the near future. There's a lot to like about both of these ETFs, which is why I own both of them. With SCHD, you get a much more diversified portfolio. We saw that in the exposure rate, and it's less exposed to technology. So when there's a broader movement in the stock market, SCHD is going to be fine. But when communication services and technology are the clear-cut leaders, obviously it's going to lag. You get a much higher dividend yield and much faster dividend growth. Now, if you want more technology exposure, it's going to give you a little bit faster in terms of growth. That's DGRW. It comes with less of a dividend yield, a little bit less in terms of dividend growth, but you do get that growth factor with DGRW, which is one thing I like, and I think both of these are great in any portfolio. In the comment section down below, let me know which of these two ETFs do you prefer moving forward, say over a 5-year time horizon. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next video. Take care.